Welcome in. Welcome in. And we are about to head into episode 3 of 3 of a 3-part series. They weren't exactly all 3 in a row because that's just kind of the way it turned out. But we had a 3-part series with Nigel Kennett, a chartered professional accountant. And so, what you're about to get into is the last of the 3. And I think, why it was so important for us to start a conversation with the chartered professional accountant. I think it's just for a number of reasons. Number one, Lacey and I, we are licensed insurance brokers and we both specialize in the infinite banking concept. And let's just face it, we can't all be good at everything. And also, I don't think we're all interested in the same things. And thank goodness for that. And so Nigel just happens to be one of those individuals who enjoys being an accountant, and he is fully licensed to speak on behalf of what the rules are with CRA. And so that makes it a lot easier for us also not to know everything, because it's hard to know everything about all the things that matter as it relates to applying the infinite banking concept into our world, especially if you're already an existing client or if you're looking at implementing the infinite banking concept. It's nice to hear directly from an accountant, what some of the thought processes are. And, I think, Lacey, you can maybe perhaps speak to what are some of the other reasons why, listening in on these 3-part series is so important.
Yeah, so I think it's as a business owner and business owners throughout all industries in Canada, accountants they're essential partners for all of us. And so this series covers important information, but in plain language, because sometimes we can get caught up in the lingo that we don't, really understand. And Nigel he helped you go into how business owners use corporate structures and life insurance all together. He talks about holding companies, talks a little bit about lifetime capital gains exemptions, eligibilities. And what's really cool for us that makes us tick is he speaks to policy loans and how do accountants view policy loans and what do we need to document and how can we work them into our business. And then another important point that you touched on was Capital Dividend Account. I know we've come across several people don't even know what a capital dividend account is most of the time. So we just dive into a lot of that and why bigger conversations require a team. And, that team can be made up of accountants, lawyers, life insurance brokers like both of us, and why it's so important for business owners to have these conversations on a regular basis, really.
Well, and I think when you're entering into the world of applying the infinite banking concept, there is so many questions on so many different levels. Like I know having a corporation myself, there's a lot I did not understand about having a corporation. I just know that I think like any one of us, when we sign up for a corporation, it's for this, one of the main reasons is so that we don't get charged as much tax. Let's just be real here, right? They have a different tax structure than that of a sole proprietorship or, when you're making money as a person. So that's the first reason and first motivation why people get incorporated in the first place. But when we layer in and we start growing up in the world of business ownership, as you're listening to any one of these 3-part series that we have recorded for you, it's just kind of a good reminder, like we don't need to know everything all at once. We learn a bit at a time as it becomes relevant to us. And also, I think it's really important because Lacey and I do bump into this in many different conversations. It's like, how do I explain this to my accountant? Or what do I need to know? Like, how is this different now that we've gotten this implemented? And so I think that these 3 series will really help to educate you so you know the answer and not necessarily have to rely on your own accountant for that answer or feel like you need to ask. Or you could still ask, of course, right? But I also think what's really important here is like there is a good portion of business owners who abdicate the financial strategy, the cash flow management to an accountant often. You know how some people, they say, okay, I got to talk to my business owner. And then there's also like the people we talk to, sometimes it's like, oh, I got to talk to my accountant about this. I got to run this past my accountant. As if like they have essentially made their accountant the boss of their company, the financial boss of their company. And this is dangerous because, well, first of all, I think some accountants really enjoy that kind of power. But I also know that there are some accountants who don't want that power. Right?
Yeah. Role clarity is something that was discussed. And so when you're listening to this, like listen for, one is role clarity. What should your accountant do versus what is your responsibility, not to outsource it to the accountant? Structure, holding companies, and trust. A lot of times people will have in their mind that they're tax hacks, that, oh, this is just a hack I can do, but they're tools, actually. Paper trail discipline, this is huge. Like, I will get on this soapbox all day. Paper trail discipline. If you're not keeping up with your papers and you can't follow your receipts and you can't, make a loan schedule when you take a policy loan, and if you're not being a responsible bookkeeper, it's not the accountant's place to keep your receipts.
Or rescue you every single time and expect them to perfectly read your mind. I think too, there's some parts where it's like, oh, I can't afford a bookkeeper. But, it's like, well, it's expensive compared to...
Well, if I can train my my hubby Reed to file receipts and do those kind of things, then there's hope for a lot of people, because it just comes down to the discipline of it. And then why insurance planning is less about the return and more about continuing on when life happens. So, I encourage you, just keep learning with us. Go back. If you haven't listened to session 1 and 2 with Nigel and Winnie, go back and start there, because there's some valuable information in there that I think will, one, answer a lot of your questions, or even maybe trigger some questions that you have in the next time you meet with us if you're already our client. Do you have anything else to add there, Winnie?
Yeah, I was just going to say that as you're really tuning in to either episode 1, 2, or 3 of this 3-part trio, just remember that our accountants are so appreciated. We appreciate you. So if you're an accountant listening to this, just know that we absolutely 100% appreciate you and you are essential. However, we're advocating that you're also not the pilot of our business. We're supposed to be, right? And, in episode 1, again, it's kind of about holding companies, trust, and, where you hold your assets and how that matters. And episode 2 is a little bit more about mechanics, how policy loans show up on your books so you don't, accidentally create tax problems. We kind of did it the other way around. So episode 88 is actually episode 2. Episode 90 is actually episode 1. But episode 3, this one, 91, right here. This one is in order, I promise. But that's just how it goes. It's how we laid it out. And so this final episode here is about just the bridge, the capital dividend account, and why, corporate-owned life insurance can really matter in long-range continuity. So again, enjoy these 3 series that you're about to listen to, session number 3. Welcome, and welcome back, Nigel. We really appreciate all of you listening to this, for leaning in today. This will be the 2nd or 3rd time around. I'm losing count already, even though it's only 2 or 3 times. And if you haven't already heard, Nigel Kennett is who is joining me. He is a chartered professional accountant who works super close with entrepreneurs and families to bring clarity to their finances. He has a gift for explaining the complicated CRA stuff and accounting concepts in a way that actually makes sense, and more importantly, helps people just like me make better decisions with just more confidence. So this is a conversation you'll want to lean in on. So what are we going to be covering today, Nigel?
Well, we want to have a conversation about holding companies and when they become practical. And then you also wanted to have a quick conversation about the Capital Dividend Account, the CDA.
That's right. I was going to create like a simple visual for you guys, but I didn't do that. It's too busy at this time of year.
Merry Christmas.
Merry Christmas. No, Merry Christmas. No, just joking. I'm not giving it to you. Maybe we can give it to you, give you a simple explanation about, the importance of the capital dividend account for all those who it's relevant for.
Yeah, sure. Let's start. That's a good place to kind of start off. So the CDA, the capital dividend account. So we all know about capital gains and what capital gains can be, and then that you pay tax on capital gains. So what happens is you bought an item of property. Say you bought investments in company ABC for $100, right? And then 5 years later, you sell them, and you sell them for $200. You have a capital gain there of $100 because you start with your proceeds, $200, take off your initial purchase costs of $100, and so you got a capital gain of $100. What happens is only 50% of that capital gain gets included into your taxable income. So you only pay tax on half of that gain. Mm-hmm. The other half goes into this wonderful account called your capital dividend account, the CDA. There's all sorts of other items that can hit the account as well. And we should specify that the CDA, the capital dividend account, only exists in corporations. This is not something that relates to individuals or sole proprietors because they only pay tax on half of the capital gains as well. But the other half they get to keep in the cash in their own personal accounts. Corporations, they've got cash in their own corporate bank accounts. So it's like, okay, well, we paid tax on half of this, and the other half goes into this capital dividend account. And what you can do is then you can declare what is called a capital dividend, which is an amount that gets issued from the balance of your capital dividend account that you can then bring into your own personal accounts, and it doesn't get reported as income, and there's no tax that's paid on because you already paid tax on one half of it. There's other items that can hit the capital dividend account as well, like insurance proceeds. So all things normal, like for really simple purposes, if the corporation is the beneficiary of an insurance policy, then those proceeds, less the ACB, go into your capital dividend account. And this pool will grow over time. And then eventually you can file an election to issue a capital dividend to yourself and bring in money tax-free. Doesn't get reported to CRA. There's no need to report it to CRA on your personal income tax return.
So before you go any further, let me just do my best to recap what I think you said here. And you know what's funny is I'm totally guilty of being one of these business owners who gets a corporation for the sole purpose of just wanting to pay less tax. I mean, that's what generally what drives people to start up a corporation, especially if they're in business, is so that they don't pay the income tax rate that's charged for personal self. So what I'm curious about is at some point with the CDA account, like it sounds like, and you're talking about ACB, which is the adjusted cost basis. Is that the right acronym?
Yeah, accumulated cost basis. Yeah.
Okay, accumulated.
Average cost basis.
Average cost basis. Sorry, you know what? There's a ACB in the world of life insurance, which I'm in, and we call it adjusted cost basis. And then when you're thinking of your corporation, ACB, average cost basis. And so, yeah, that can get really confusing, especially if you're in the same industry as I am. So is that a moving target in terms of your average cost basis and what's in your CDA account, like how it's calculated from year to year?
Yeah. So your CDA, that capital dividend account, is going to be adjusted every time there's a capital gain that's incurred by the corporation, every time there's been an insurance payout to the corporation. But then there's also things that can kind of grind it down, such as capital losses. Capital losses will reduce the capital dividend account. But it is a pool, and so it can grow over time. And depending on the types of transactions that allow it, such as capital gains or capital losses, insurance payouts, and things like that, that will impact the size of that pool.
So is there ever a point where the capital dividend account grows to a specific size where it just almost makes sense to open up another corporation?
No, there isn't a limit on how big your capital dividend account can be. And I should specify as well that this is also for Canadian controlled private corporations. Okay. So like your regular mom and pop shop that's got like operations and things like that. So, or even a holding company.
Right. And so does this also apply to holding companies?
Oh yeah, absolutely. It does. Yeah. as long as it's a private corporation.
Okay. So what's the difference between an operating company and an holding company as it relates to the capital dividend account?
So both types of entities will have a capital dividend account. It's just what's the most efficient way of using it, right? So you've raised a good point, like an operating company versus a holding company. What's the difference? So your operating company is going to be where a lot of the primary business activities are going to occur from it, right? So think of
Are going to what?
that they're going to occur, right? So like a farm would be like there's active income that's generated in a farm or a ranch, or like a small independent retailer, right? Or sometimes real estate agents will operate through a corporation. A lot of other businesses, such as like trades or restaurants, will have a corporation. There's this active business where there's the deliberate sale of a product or service, right? And so these active businesses can have a capital dividend account as well if they have things like investments or that corporation's listed as the beneficiary, right? A holding company, on the other hand, is going to be more passive in the types of income that it generates from. That's not to say that all the income is going to be passive, but a holding company is a good way of shielding assets from an operating company. So a really good one to think about would be, say there's a paving company. And we'll say that they've got dump trucks and things like that, and that they're doing country roads where they're paving range roads and things like that. And imagine that one of their drivers leaves their bucket up and drives through and takes out some power lines, right? That can be really expensive. It can knock out grid for the whole area, right? Things like that. So it can be very expensive.
A very unprofitable project.
Yeah. And so in a situation like that, like there could be lawsuits that are levied against the company and things like that. And if there is a lawsuit, then that company can be on the hook, and all the assets that are in that company could be on the hook as well. If there's a holding company that has a separate reserve of cash and where there's equipment and things like that, then it could be shielded from that lawsuit. To be clear, like I'm not a lawyer, I'm an accountant. But a holding company can help limit the liabilities that are incurred by an operating company by providing an extra layer of protection by having a separate legal entity hold all that equipment.
So right? I would say, just from what you're saying, so inside of an operating company, it would be okay to have like equipment registered as assets under the operating company. But if it's land or a life insurance, like a dividend paying whole life insurance contract, those are like the type of pieces that would be better suited to being inside the holding company.
Attention, each situation is going to be unique. So even in a situation where you're suggesting that the equipment be held in the operating company, I'd even counter and say that the equipment should be held in a holding company and that they're renting that equipment to the operating company. So if there was a holding company in this paving company example, right, then the paving company would basically just rent the trucks and pavers and everything else from the holding company.
Okay, interesting. So in terms of, again, Stephen Covey, the 7 Habits of Highly Effective People, if we keep the end in mind, and most of our listeners here are in the agricultural industry who quite often think or are constantly thinking about, okay, how can I pass this off to the next generation? Or if they're wanting to, just get out of it altogether because they don't have someone to pass it off to, like whether they're like a non-arm's length or arm's length kind of transaction, then is it also better to have those pieces in the holding company rather than in an operating company?
Yeah, potentially. Absolutely. And so when we're talking about agriculture, there's a number of rules that allow for intergenerational transfer of assets and land and things like that, so that we can really kind of hold on to cost bases and defer taxes down the road until property and the farm is ultimately sold to a non-related party, right? So there isn't really a best fit answer for that is universal. It's all kind of case by case. But yeah, absolutely. Potentially there could be ways that you can hold equipment in other legal structures to limit liability and risk.
Well, I'm just thinking about like ease of transferring from one generation to the next, just say. Again,
Yeah.
if it's within the family.
Yeah, if it's within the family, then having corporations and things like that can be beneficial, but it also could be beneficial to hold on to things still as individuals so that we can apply the full gambit of intergenerational transfer rules to things for farm property and things like that. So, but absolutely, that's a big conversation. Like, that's a very big conversation, but absolutely, like, these are some solid tools to have in the tool belt when we have those deeper dives with individuals and how they're trying to plan out for the future.
So when you say big conversation, like your eyes even went big. Like, so if you can actually see, and you're on YouTube right now, you could see how Nigel's eyes just popped, right? Just to emphasize what he means by big. It's like eye-opening kind of big. So if this is a big conversation, like, at what point should a person start talking about this with someone like yourself?
Yeah, they should call their accountant up and schedule an appointment to say, like, hey, this is what we're looking at in the future. How can you help us get there? And how can we make sure that we do this the most tax advantageous way? Right?
Yeah.
So it's always best to plan for the future today. Rome wasn't built overnight, but it definitely burned down in a short period of time.
Isn't that always the case? Yeah, it's kind of like the wedding. It took like forever to plan, and then it only, like, the day in and of itself, it only lasted a day, but it took months.
Yeah.
And then it only took hours to like clean up after the whole thing was done.
Yeah.
So it's always in the preparation that takes the longest. So would you also say that, as it relates especially to a corporation or a holding company, when you're doing planning with someone like yourself, which I don't know, like, are you always open to take more business, or are you kind of like
I love sitting down with people and having conversations. That's the best part of the job. I love working with people to see what their future looks like.
Yeah.
Because it's always so uncertain. And I really enjoy helping people manage that uncertainty so they can prepare and provide them and their families with the best possible outcomes.
Nice. And so you are open to taking on potentially more clients, is what you're saying?
Oh, absolutely, yeah.
Okay. Yes. And again,
if a way of saying yes.
And again, if you're not actually on YouTube and you're not watching us by video, which it is offered. So if you're on like Spotify or iHeartRadio or Apple Podcasts, like, come over, see us on the podcast so you can see how experienced, but also how surprisingly young Nigel is. Like, he's not like in his 20s or anything like that. Maybe you're in your mid 30s, maybe, but
I got a little bit of salt in my pepper, so.
Exactly. And so Nigel is nowhere near like going to retire, like in the next, well, maybe he's hoping to, but he's young. You know what I mean? Like, there's nothing like, ending up working with an accountant who's on their way out the door. So just know that. Anyways, I like Nigel very much. So it's a soft plug for you guys.
Thank you.
You're welcome. And then, so I guess coming back around to the question of when people are having these big conversations that you were talking about, would you also recommend also making sure that a lawyer is also involved in the initial planning process?
I've heard it said, and this relates to the mafia, but you always want to make sure you got a good priest, a good doctor, a good accountant, and a good lawyer, right? So if you got those kind of major cornerstones covered, then you should be set. So absolutely, it's always a good idea to have a strong lawyer in your corner. The Income Tax Act, at the end of the day, is a legal document. And so having a lawyer with that strong background to make sure that the law is being executed correctly is absolutely important.
So you do recommend then having a lawyer and accountant together planning for the future, like at the same time. At what point do we involve the accountant? At what point do we involve the lawyer? You know what I mean?
Yeah. Once you, like anything else, you want to identify that you need a plan, right? And then it's always best to say, like, okay, what are my goals? What are my future ambitions? What are my expectations? And then just start jotting down ideas and thoughts. And then pick up the phone and give your accountant a ring and say, like, hey, this is what I've been thinking about. And then start that conversation with your accountant after you decided what is best for you and for your family.
And then once you've had that, so what are you saying then, Nigel, then once you've had a conversation with your accountant and your accountant kind of gives you a general idea about some possible options, then at that point, go to a lawyer?
Yeah, I guess if we wanted to step it out that way, then that could be a good way of going, because as accountants, we've provided lawyers with instructions of how we want to do things. And then the lawyers will then in turn say like, yeah, okay, absolutely. We can prepare the will, for example, to be this way. Yeah, we can make sure that the executors are updated this way, right? And so it's always good to include the lawyer. I don't think that the lawyers are probably going to disagree with me. But at the onset, I don't necessarily see there being a need. But you know what? A lot of people will start off having a conversations with their lawyer first, and then the lawyer will then turn around and involve the accountant. So it is a tandem effort. But the primary piece is for individuals to sit down and decide for themselves what they want to look for or what they want to have and what their expectations are. And the planning is built upon their goals and ambitions.
Well, it's interesting. Every single business, no matter what business you're in, an accountant's always a part of that process because you have to, because of, our need to file every single year.
Yeah.
Right. But what I also noticed and have observed is that not always is a lawyer involved. And so that's kind of like why I ask. And because I think that a business owner could go, some businesses anyway, can go years and years and years without ever having to involve their lawyer unless it's for estate planning purposes. And so what is the risk in doing that, like not involving your lawyer?
I have had situations where a lawyer wasn't involved. I actually had a conversation with a financial advisor just last week, and it was about a trust situation, and things hadn't been set up correctly. And so they tried to set up an incorrect trust that was actually outside the bounds of what trusts are able to do in Alberta. And the lawyer, it was totally overlooked. The risk of that is that if you set up, in this situation, a trust incorrectly, it can impact all sorts of things like benefits. It can disqualify you for all sorts of different things. So making sure that you've got a strong team in your corner to make sure that you have a financial advisor that knows their limitations, and having an accountant that knows their limitations, and having a lawyer that knows their limitations means that everybody's creating an exceptional piece of work for that estate planning and for their clients. The important thing, I was very deliberate in saying limitations, is that people have to know what their limitations are and to know how to defer to someone in an area of stronger expertise, which is why I always disclaim and say, I'm not a lawyer. And a lawyer is going to make sure that we are actually fulfilling the way that our instructions are actually legal. So we are being compliant in every area.
Gotcha. So it is quite important. Yeah.
Yeah.
Okay. Now, you talked about a trust. And so we've talked a little bit about, the role of and the benefit of having a holding company in place for protective measurements. And then at what point would you think a trust could be a really great idea, especially when you're thinking about our audience here for ranchers and farmers and wanting to ensure that the rancher farm stays in the family for generations to come?
Yeah, trust can be really good. And we talked about this last time when we decided to nix it. But trust can be a really good way of multiplying the lifetime capital gains exemption when there's the disposition of shares in an active corporation, right? So sometimes trust can work and sometimes they can't. So, and if we're talking intergenerationally, a trust may not even be the best tool to implement because we've got the intergenerational transfer rules, which could make introducing a trust obsolete. And so then you just got additional filing and compliance requirements that are going to increase your costs and provide you with no lasting benefit. There's been a number of changes that have been made to trusts. When you register a trust, when you want to register the type of trust, there's dozens of different types of trusts that you can register. But at a high level, trusts are generally taxed at the highest marginal tax rate, depending on your province. Here in Alberta, I'll just say 48% for simplicity, right? But yeah, a trust will get taxed at the highest marginal tax rate of 48%. And that's any income, taxable income to that trust. Now, there's different way that we can take advantage of some other tax provisions by implementing a trust, such as multiplying the lifetime capital gains exemption. But trust can definitely have their place which is why it's important to have conversations about what you want your future to look like to see whether or not a trust makes sense to implement in your long-term estate planning.
Yeah, and that I say for that one, definitely involving both accountant and lawyer. The hope with a trust is that you can protect the wealth that's been built over generations. I think that's probably the biggest one. So, okay, with that being said, I think that's really great. And then the other pieces that we were hoping to cover, is there anything that you could maybe perhaps speak to in terms of what you've come to understand about, the whole life insurance contracts that you could offer related to corporations or holding companies or trusts for that matter that you could offer?
Yeah. So having a whole life insurance policy in a corporation can be a very strong way of taking advantage of that capital dividend account that we spoke to earlier, right? And sometimes what you'll see as well is that if there's a number of assets that are in a corporation, that you can use assets and liabilities, right? Because if there's a deemed disposition upon death, right, then you could have an enormous tax liability that would fall into your estate's lap, right? And so having a whole life insurance policy where you've got corporation as a beneficiary and being able to take advantage of the capital dividend account can then, like on death, there's going to be cash disbursements that you can help use to offset tax liabilities and things of that nature, right? And so it's a good way to help protect the organization to make sure there's sufficient cash to cover those unanticipated consequences of dying.
Yeah. When you compare that to other ways, like, I'm not sure if you've ever dealt with having to, what do you call it? Is it the death file? Like what's that called again? Like what's the official name called when a person passes away and it's the final tax return? What's it called?
It's just called their final return.
Okay, final. Well, hey, that's
there's
so simple.
Like there's rights and things and things like that. But yeah, like the final return.
Yeah.
Aptly named final return.
Final return. Okay. So for the final return, based on your current experience, has there been more of an advantage for people that have had at least whether it's term insurance or whole life insurance or universal life insurance? Is there definitely more of an advantage of having life insurance as a part of that mix when filing for a final return versus people who don't have any life insurance coverage at all?
So when we're discussing the final return, so CRA's position, the government's position, is that prior to your death, the moment immediately before you die, there's an immediate disposition of all of your assets and property. And depending on what your assets and property are, there could be significant gains that are triggered. And then, say an individual who is single passes away and they can't transfer their property to their spouse, for example, then there could be a fairly hefty tax liability that is incurred. And ensuring that you have appropriate mechanisms in place to cover that tax is key. And absolutely, having a whole life insurance policy is one of those tools that can really be beneficial and advantageous to address those types of concerns.
Would that be any different if you just had a term policy or universal life policy?
Potentially. Term insurance is, as the name implies, is just for a short period of time, and then you get a lump sum payout. And so that can provide benefits too. But one of the greatest advantages that you have about whole life insurance policy is being able to use it to borrow against, right? And being able to use it as collateral. So if we're talking just from a tax liability perspective, having the appropriate amount of cash, which can be provided from having a whole life insurance policy or a term insurance policy, will provide that benefit. But it's really having that advantage of being able to borrow against your whole life insurance policy that you see additional benefits.
Nice. I was seeing how are you with the knowledge of the universal life policies? They fit a very certain group of people, but are you familiar by chance? I know we never talked about it, but
no, I know about term insurance and I know about whole life insurance.
So the universal life insurance contract, I've already researched it enough to know that it doesn't fit the criteria to exercise that mindset. But what I do know about the universal life policy is that it's an interesting like hybrid product between like a permanent life insurance contract and investments. It actually has like an investment portfolio to it as well, right? So of course, with that, given that that like if, the life insurance part typically is not taxable, but then once you include the fact that there's an insurance piece to it, then of course the taxation around investments is different than life insurance.
Yeah, I would.
Yeah,
I don't know if I'd be able to truly provide any reasonable commentary on that, just because if we're talking about investments that are held within an insurance policy, then there could be different applications and treatment of all that. So.
Right. No, I didn't expect you to. I was just like simply sort of giving some context to anyone who's listening. A universal life policy is like that. It's like a hybrid of permanent life insurance and an investment portfolio. It's a mix. And it was created in the 80s when the interest rate environment in Canada was super, super high. It was like the sexy new blonde that came out on the market and distracted everyone. So I'm like, okay, that's an interesting analogy, but not as effective as permanent whole life insurance based on my very, very biased opinion. Thank you. Let's just be real. Okay, I think we covered a ton of ground in today's session. And unless you feel like there's any gaps, Nigel, that we can sort of finish off with?
No, I think this is a good place to wrap up.
Okay, sounds really good. Thanks for leaning in, everyone. We'll see you guys later.
Okay, thank you.
No, thank you. All right, welcome back. That's the end of our 3-part series with Nigel. We truly hope that you got a lot out of these 3 sessions and you have a lot more clarity about what you need to do or what you need to know. So, Lacey, do you have any sort of final thoughts or what are some next steps?
So, as always, the next step, if you don't have the book already, that's your first step. Head over to our website, ranchyourway.com. And you're going to be able to get the book bundle there. There's a button right on the website, right when you log in, or hit the website. It screams at you pretty much. So keep learning with us, guys. Some of this information in these last few episodes may seem a little bit deep, but keep learning because the first step is the book. And then that's when we get into these deeper conversations about, okay, what does it look like? The holding company, the tax, like all of that. So keep learning, head over to our website. If you would give us a 5-star review, we would so appreciate that. Apple, Spotify, iHeartRadio, or you can watch us on YouTube. Till next time.
So glad you leaned in with us on the Winnie podcast. We truly hope you're feeling more informed and empowered to take another step towards optimizing your financial life. Right now, make sure you hit subscribe so you can keep growing and learning with us. Until next time, we wish you prosperity in every area of your life.